recently passed tax reform legislation may impact planning on the farm or ranch. Nebraska Farm Business Inc's Tina Barrett joined us earlier this week to discuss some key aspects of the bill. One issue that received significant media attention was the new $10,000 deduction cap for state and local taxes. Tina says that caused confusion among landowners who thought the cap applied to business real estate and wondered if they should prepay those property taxes.
Well, I think that was one of the biggest things that was missed in all those news stories, that the property tax that they were talking about is your property taxes on your personal residence that we would deduct on Schedule A. Has absolutely nothing to do with business real estate taxes. So there would seem to be a lot of concern and almost panic about needing to get those property taxes paid or being limited to $10,000 next year. And again, that only applies to that state income tax and personal real estate taxes on your personal residence that you would file on Schedule A, which would be your itemized deduction. So it has nothing to do with that Schedule F stuff. And there's also been, there was also rumors about business interest being eliminated. But again, no issue there unless you gross more than $25 million. And then there's some special rules we have to follow. So if that affects you, then you'll want to take a peek at that. But for the most part, business real estate tax and interest are just the same.
Tell me how this legislation changes what you can do with deductions.
Yeah, so let's think about the standard deduction has been about $12,000 for a married filing joint couple. They've raised that to $24,000. So that's a nice thing. And the idea was to eliminate how many people needed to itemize. Okay, and so that's a good thing. It is going to reduce that a lot. So there's a couple things that we need to think about in there. One of that was potentially prepaying those personal real estate taxes. Another thing is potentially changing the way you do charitable contributions. So we've always had the ability with farmers to be able to give grain instead of cash to any qualified charity, have that not show up on your Schedule F. So if your standard deduction's not is going to be the way to go for a while here, you might want to consider switching those gifts to grain this year. So again, some simple rules to follow, so make sure you contact your tax advisor on that, but might be something to think about.
Depreciation changes in what way?
So we got basically unlimited depreciation. They took the 179 limit from $500,000 to $1 million, brought bonus back in at 100%, said the bonus could be on new or used property, and that's 100% no limit. So we basically have unlimited depreciation. The trade-off, the reason they went that way, was because they eliminated the 1031 exchanges on personal property. So we always think about 1031 exchanges with real estate, but when you trade a tractor in and don't pay tax on that gain, you're doing a 1031 exchange, and most people don't realize that that's what they were doing. So when you go to trade that tractor now, we're going to have to recognize the gain, but we're going to have that offset in depreciation to make up for that. There's going to be some issues on the state's side of that, but some be personalized as we go.
How did the tax rates change for businesses here?
So a couple things that as we talk about and hear different things for that. There's the corporate rate. So the C corporations that pay their own taxes, they have a flat 21% rate. They had before had a graduated scale that peaked at 39%. So now it's flat 21, which is nice and simple. A lot of the producers that we work with use the 15% bracket in that corporate one, and that was about all we used. So those guys are going to actually see a tax increase because from $1 they're going to pay 21%. But the benefit of someday getting out of those C corps with a flat 21% is a real benefit. So there's a trade-off from right now, but it'll be a benefit in the long run. Then the other thing that we're hearing about is the pass-through entities. So this is S corps, partnerships, and then the Schedule C's and Schedule F's that are sole proprietors that really aren't pass-throughs, but they're falling under this law. And we're getting a 20% deduction on that. Lots of rules, lots of things that trigger into this. Pretty simple if you're making less than $315,000 a year. More complicated if you're making more than that. This looks like it could be a huge deduction for some producers. So it's really a kind of exciting thing. Biggest difference, the deduction for the pass-through entities and Schedule F's is set to sunset, where the 21% for C corporations was made permanent.